Another case study with a difference in finding weighted average cost of capital. Let's see. X Limited has the following capital structure which is considered to be optimum. I'm stressing on optimum as on 31st March 2013. They have 14% debenture 30,000, 11% preference shares 10,000, equity 10,000 shares, it is 160,000, so total is 200,000. The company share has a market price of 23.6. Next year dividend per share is 50% of 2013 EPS or year 2013 EPS. The following is the trend of EPS for the preceding 10 years which is expected to continue in future. So if you look at this table, we have information right from 2004, 5, 6 and I think in the next slide, 7, 8, then it goes like this, 2009, 10, 11 and 12, 13. So if you notice in 2004 EPS was 1, in 5 it is 1.1, in 6 it is 1.21, then in 7 it is 1.33, 1.46, so it goes like this, it goes up to 2.36 in 2013. Then we have the company issued new debentures carrying 16% rate of interest and the current market price of debenture is 96. Preference shares rupees 9.20 with annual dividend of 1.1 per share were also issued. The company is in 50% tax bracket. We have to calculate after tax what is the cost of new debt, what is the cost of new preference share, then new equity. Then we should also calculate marginal cost of capital when no new shares are issued. Then we have some more. How much can be spent for capital investment before new ordinary shares must be sold? Assuming that retained earnings for next year investments are 50% of 2013, which we'll discuss again. Then item number 4, what will be the marginal cost of capital when the funds exceeds the amount calculated in question C, assuming new equity is issued at rupees 20 per share. Okay. So now let us focus on question 1. Where we have to find out cost of debt, preference and equity. Okay, let's go ahead. Question 1, find out cost of new debt. It's going to be simple. Cost of debt is I multiplied by 1 minus T by NP. Here we are not going for that exhaustive formula because we don't have information about redemption time period and all. Okay, so we'll say it is 16%. So 16 multiplied by 1 minus T divided by net proceeds is 96. Okay, so cost of debt is 8.33%, fairly simple. Question 2, we have to find out cost of new preference share. Again, it is going to be very simple. It is PD divided by MP because we don't have information about redemption number. So preference dividend was 1.1, market price was 9.2. So cost of preference shares was 11.96%. Okay. Then question 3 is critical. We have to find out cost of equity. The formula is D1 by P0 plus G. So what is D1? What information? I think D1 is going to be 50% EPS of 2013. That's the information we have. D1 is equal to EPS of 2013 multiplied by 50%. So what was the EPS of 2013? It was 2.36 multiplied by 50%. So this is going to be the D1, which is 1.18. What about P0? I think that is available, no issue. But what about growth rate? For growth rate, if you recollect the table which was given in the question, I'll just run through that. Yeah. So if you look at this table, year after year, this dividend is growing. Year after year, this dividend is growing. And if you measure the growth from 1 to 1.1, it is a 10% growth. From 1.1 to 1.21, again it is a 10%. From 1.21 to 1.33, it is 10%. So like that, if you measure all the years, it is actually growing at 10%. It is actually growing at 10%. So from this, we can infer the growth rate of dividend is 10%. So this can be applied in the formula. So let me do that. That can be applied here. We can say growth rate is 10%. Okay. And we know market price is 23.6. So by applying everything in the formula, 1.18 divided by 23.6 plus growth rate of 10%, we get cost of equity as 15%. Okay. So now we have all the relevant information. Let's go and find out the cost of capital. Here It is basically marginal cost of capital, okay, and assuming no new shares are issued. Okay, why marginal cost of capital and why not weighted average cost of capital? See, already they have a capital structure. Okay, now if there is no new shares are going to be issued, it means the existing structure is being maintained. Okay, if no new shares are issued, it means they always try to maintain the existing structure. In that case, what is going to be the cost of capital? So for that, what we'll do, we'll bring the existing capital, I mean the components, to know the composition, to basically to know the weightage. Okay, so sources 14% debenture, 30,000, 11% preference, it is 10,000, and equity is 160,000. Please understand, we are not trying to calculate cost of capital on these, no. But the question says, the first line of the question says, the company considers the existing capital structure as optimum. It means it is not going to alter its capital structure. Okay, so for finding the cost of capital, I am just going to take the proportion or weightage of these funds and I'll be simply multiplying them with the cost of capital which we have derived. It means we are not calculating on these funds. Okay, so the total is, it's 200,000. So now we can find out the proportion. 30,000 by 200,000, it is 15%. 10 by 200, it is 5%. And 160 by 200, it is say 80%. Okay, so now this proportion can be multiplied with after tax cost or specific cost, which we have calculated. 8.33 for debenture, 12 for preference, and 15 for equity. Now by multiplying respective, we get weighted cost of capital, which is 1.25%, 0.6%, and 12%. And if we total this, we get to know what is the marginal cost of capital here. It is 13.85%. It is weighted marginal cost of capital 13.85%. So this is the first part. Then the next question, how much the company can spend without increasing the marginal cost of capital and without selling the new shares. Okay, so they want to know how much amount they can raise and spend, but they don't want to issue new shares because issuing new shares can probably alter the capital structure. Okay, so now they know there is some retained earnings. When retained earnings increases, parallelly the other source of funds, basically the debenture and preference, should also increase to maintain the capital structure. But in this process, what is happening? The equity is not getting increased. It means the equity shares are not getting increased, but equity amount is getting increased. Okay, and parallelly the preference and debenture should also increase, but all these are happening without issuing new equity shares. Okay, so how do you know that? For that, you should first of all find out what is the retained earnings. See, in 2013, whatever EPS, 50% was distributed as dividend. It means the remaining 50%, that is 2.36 was the EPS multiplied by number of shares. So this will give the total earnings, in which 50% was already distributed as dividend. It means remaining 50% is the retained earnings. So this happens to be 11,800. And we know from their existing capital structure what is the proportion of equity. For that, if you want to understand, just go back. What was the composition of equity? The composition of equity is 80%. It means this 11,800 should form part of that 80%. It means there is some addition to equity by 11,800 which represent 80%. It means there should be corresponding increase in other funds to the extent of 20%. So what I'm going to say, if this 11,800, okay, is representing 80% of total capital, then what is 100%? So what I'll do, 11,800 divided by 80%, 0.80. So 100% is going to be 14,750. It means when there is contribution of equity in the form of retained earnings by 11,800, then there should be simultaneous increase in debenture and preference so that the total position would become 14,750. Only then the capital structure will remain unaltered. Okay, so now answer to the question, how much the company can spend without increasing marginal cost of capital and without selling the new shares? Answer is 14,750. Okay, so that's about your question C. Moving on to question D. If the company spends in excess of 14,750, then what is going to be the cost of capital? Okay, if the company is going to spend in excess of 14,750, it means their capital structure will get altered, it will get disturbed. Okay, so when that happens, what is going to happen? Their cost of equity also will undergo a change. That's the information we have in the question. Let's see, if the company spends in excess of 14,750, it will have to issue new shares. So when it issues new shares, then cost of new share will be different because there are some changes in dividend or market price. Let's see, we have 1.18 divided by 20 plus the growth rate of that 10%. So there is a change which is happening in the market price, right? Because dividend whatever was there, like 2.36 into 50%, there is no change in the dividend, but the market price is coming down. Okay, and accordingly the cost of equity will undergo a change. The cost of equity will become 15.9%. okay, so cost of equity is undergoing a change. Now let's try to find out what will be the marginal cost of capital when there is going to be an increase. We'll have new equity, then I think the other elements will remain same, but the cost of new equity is going to be different. So these costs have to be multiplied on the proportions which are maintained. See here, what is going to happen to the marginal cost of capital is there is increase in equity, but the existing structure is not getting altered. So that's where we need clarity, because the company says, or the question first line says, the company considers the existing structure as optimum. It means 80 should be equity, then 5 and 15, those two other components. It means there is no compromise in that. Okay, so this cost is going up in that 80% component. So what is going to be the effect on it? So what we'll do, we'll capture a table. The marginal cost of capital is going to be where we'll list out the capitals. What are the capitals we have? So here you have the 4-column table: type of capital, proportion, specific cost, product. And if you notice, I'm not even bringing the value of those funds. I'm just bringing the type of capital because I'm more interested in the proportion rather than the values, because of the first line in the question which says that the existing structure is optimum. It means I'm not at all bothered about the amount, I'm bothered about the proportion, which I'm not even altering. Okay, so let me bring those capital, the capital or debt, which is 15%. Then the specific cost, no change, we have already calculated, which is 8.33. If you multiply, you get 0.0125. Then preference, again the proportion is 5%, 0.05. The cost we have already calculated, it is 12%. Multiply, you get 0.006. Now the only issue is with regard to equity. So when you go for equity, again the proportion is maintained at 0.8, but the specific cost has undergone a change. So 0.8 into 0.159, you get it as 0.1272, and the total position is 0.1457. And understand, this is marginal cost of capital. This is not the overall weighted average cost of capital. Okay, so when they go for additional funding and when they go in this proportion, what is going to be the weighted average cost of those additional funds, which we call as marginal cost of capital, and in this case it is 14.57%.